Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello everyone, it's Thursday the 6th of February as we record. The Bank of England has just cut interest rates. The FTSE 100 has hit another record high this morning, notwithstanding some brief tariff-related uncertainty earlier this week. So what better time for the arrival of our annual FTSE 350 review, wherein we examine all non-investment trust companies in both the large cap index and the FTSE 250, all in one big helpful guide. To mark that occasion, today on the show, we're looking at three companies that have also reported results or trading updates this week. Starting with the biggest UK-listed business of them all, AstraZeneca. Julian Hofmann is here to talk about its latest figures, as well as those of rival GSK. And we may touch on the politics of Astra's decision this week not to proceed with its UK vaccine factory as well. After that, we move into the FTSE 250 to look at a company with shakier foundations, housebuilder Crest Nicholson, which earlier this week warned over its ability to continue as a going concern. Natasha Voase will discuss the company's delayed full-year results and ask how worried, if at all, we should be about the business. And lastly, we'll return to the large cap index to talk through a trading update from one of the success stories of recent years, caterer Compass Group. Mark Robinson will hold forth on its trading update later in the show. Alex Newman will also chip in on Crest and Compass as well. But we're going to start at the top. AstraZeneca last year wasn't entirely plain sailing for a number of reasons, Julian, but shares are up 5% today on the full year figures. What did the market like?
The market liked quite a lot, Dan, actually. The context obviously is that AstraZeneca, along with the other pharma majors in the UK, had a pretty bad 2024, so the shares have come down a bit. And what the market like today was the fact that they have reaffirmed most of their earnings guidance. In fact, the earnings surprised a little bit to the upside, as it were. And they look relatively well poised to generate about 80 billion of revenue by 2030, which is the big long-term plan for them. And there was a lot of evidence in the results that insistence on going within oncology is starting to pay off quite handsomely. They're looking at revenue growth in some areas of 44% annually, which is pretty extraordinary, really, for a mature pharma company. And it seems to have put to bed a bit of the worries that the market had over the course of the year, where firstly you had this regulatory issue in China. It looks like fines, which in the context of its business is pretty much a rounding error. So I think people have started to discount that as a problem, although I think their executive there is still in prison. So hopefully they'll spring him at some point. So yes, it's a combination of the fact that they look stronger than the market was supposing, and that's been helped by the fact that the final quarter of the year particularly was a very strong quarter for AstraZeneca, as indeed it was for other pharmaceutical companies. There seems to be a combination of lower costs coming through because of supply chain issues easing. The last quarter is anyway when most people collect the money from shipping product earlier in the year. So it has to be a strong quarter anyway, but this was a particularly strong quarter.
Indeed. There's lots of positives from the company's point of view there. The China investigation, as you say, that executive was arrested. It appears to be over unpaid import taxes, or certainly the company thinks so. But yes, it does seem to be a situation where I think Pascal Soriot said the bill could get a bit bigger, but not much bigger. China sales are struggling still a bit as well. But as you point out, there are lots of other plus points, lots of other strong growth areas, which is what you'd want and need really as a pharmaceutical company, where you've got some drugs coming off patent and starting to dwindle away, and others really starting to ramp up. Let's talk about that in the context of those 2030 targets, that $80 billion in sales, which obviously in and of itself is a huge figure, because there is some way to go to reach that level. And Astra, perhaps in a bid to reassure the market today, said that 2025 will be a very catalyst-rich year.
What they mean by that, I think, is that a lot of the products that they forecast will contribute to that number, that 80 billion revenue number, they're up for appraisal and or approval this year coming. So they've got 7 trials reporting this year. Last year they had, I believe, 8. So Astra at the moment is generating a lot of data to support its products. Some of these are new products, but they're also new indications for stuff that's already in the pipeline. So things like Untitled, which is breast cancer drug, that will be cross-reference for other types of cancers, and they've had quite a bit of success in getting that certified for other conditions, other indications. So I think that the market did like the fact that Astra is generating this much news flow. I think that's what he means by the catalyst. And when a phase 3 comes through and the approval, usually within a month, 18 months, something like that, you can say that 3 or 4 years down the line, you start to see significant amounts of revenue. So, but when you add all that up, it makes more the 80 billion figure for 2030, which some people had actually been a bit skeptical about, without contribution from China, for example. It's starting to look more plausible just on the basis of their existing business, which I think is for investors has been quite positive, really. Or at least they've taken that in a very positive way. There were a few bits that weren't quite brilliant. I mean, the vaccine business was down, but Astra is not really a vaccine company, so I think you can just discount that as relatively peripheral to its core offering, which is definitely this hard to copy oncology specialism, which is definitely just continues to grow all the time with the new indications they're adding.
What about all this in the context of the valuation? Because there is still, of course, a way to go to 2030 and a 5-year plan, all well and good, but lots can possibly go wrong, go right in the meantime. How do you see the valuation case for the company at the moment?
Well, I mean, obviously, it looks more positive than it did, say, in the summer. And you were paying up to over 20 in the summer for Astra. Then they had that big fall on the back of the China news, and they're now rated about 17 times forward earnings. That falls again to about 16 and 15 over the next 2 years, and I think that's good value. I mean, the problem is that if you look at their competitors, the competitors are considerably cheaper, probably 50% at least, when it comes to pharma valuations, and it depends on what you want the shares for. So if it's an income share, it's probably not as attractive. Our pharma is traditionally the cornerstone of an income portfolio, but it's not as value attractive as say a GSK, for example, which is probably half the rating of AstraZeneca at the moment. But in context of where it wants to go by 2030, the shares at the moment I think are looking quite good relative value. I think you're assuming really that their revenues and earnings will almost double within the next 5 years. So, but the rating is still only 17 times. So yes, it's I think for a value investor, it's quite an interesting time for them to look at AstraZeneca. As indeed probably is looking at GSK in the same context, really.
Yeah, we'll come to GSK in a second. I just wanted to touch on the vaccine factory plans, which is probably what most people would have seen the company in the news for this week. The plans for a manufacturing plant have been cancelled. There was a lot of wrangling with the government over the amount of public money provided. I think the previous government had suggested 90 million. The current government, some suggestion that went down to 40. In the end, it was about 80, but that wasn't enough for Astra. Now the plant is off. Yes, from Astra's point of view, it's a relatively small part of their business, but it doesn't necessarily look great from the UK point of view, I suppose.
Well, I don't even know if it was particularly substantial from a UK point of view. I mean, there's like 30 billion of assets in total in the UK in terms of pharmaceutical facilities, and this is 450 million. So it's not particularly material certainly not for AstraZeneca, and it's probably more the optics of it rather than anything else. that's bad for the government. For some reason, this pharma companies always want to build plants spewing out chemicals in Speke in Liverpool, but I don't know why that is. But obviously, it wouldn't help the economy of the Northwest if Astra decides not to put anything there. But in the round, it probably isn't into anyone's real advantage or disadvantage, but it certainly doesn't look great if one of your most successful companies has decided that the UK is not a viable investment destination at the moment.
Indeed.
But there are external factors that may be influencing their thinking, not least the threat of tariffs and stuff to the US. And AstraZeneca is a very important player in the US market.
Yeah, that may well be the case, mightn't it? If you're a company like that, thinking it might make sense to build a few more factories in the US and therefore at least show some goodwill, which, let's face it, based on what other companies are doing, appears to be their primary motivation at the moment. Just getting on the right side of the new administration there, shall we say. Anyway, let's turn to GSK, which had its own figures a few days earlier. Once again, quite well received. GSK's been, AstraZeneca's been up and down, as we said, but GSK in recent years has been more up and down, but these figures seem fairly strong as well.
Yeah, the share price has been relentlessly declining since May, which is an earlier start point than Astra in context. But the figures were quite positive. I think people took heart from the fact that they're doing a £2 billion buyback. Obviously, that will help to support the share price, at least in the first couple of quarters this year. Dividends were also up, so that's always positive for income investors. The problem with them is that their vaccines business is another important part of what Astra does. They are more exposed to the vagaries of what the US administration decides to do with vaccines. You have a potential head of the agency over there who is an avowed vaccine skeptic, and this may impact some of their business, particularly their big vaccine is called Shingrix, which is for shingles prevention, and they have other ones for RSV and human papillomavirus, which are also quite important. So the vaccines business has slowed in terms of revenue growth, although the company did note that things like immunization rates are actually going up, so it doesn't seem to have affected public perception, as it were. But their growth is definitely outside of America. If you look at the balance of sales for the vaccines division, it seems to have shifted away from the US market, which is a new sign. Partly GSK has been going after vaccine sales in the developing world and in rising economies. So that should perhaps not be such a surprise. But the fact that it's happened this shift is happening over the course of a couple of quarters is quite unusual. So there might be something underlying going on there, which might worry investors a little bit about the viability of the vaccines business. But GSK is. I'm sure aware of the issue, and this is why they've been growing other parts of the pipeline quite successfully, actually, you have to say. So the oncology business has gone from a standing start to essentially, Astra didn't do oncology really, and that has now gone to £1 billion+ business in a very short period of time. So there is a definite plan, I think, there in place that might diversify their business more successfly, and they have been buying drugs this year.
Yeah, there was a recent acquisition, wasn't there?
Yes, IDRX-42, which is for gastrointestinal cancer. So it's a relatively specialist, difficult to treat area, and they paid over $1 billion earlier in January for this particular drug by buying out a US biotech. And it is a sign that they have the ambition, at least, to follow AstraZeneca's lead in that area and try and find hard to treat conditions that will respond to a new therapy. That's the trick to getting these things approved by the FDA or the regulators. It has to be an improvement on the current standard of care or the current standard therapy. So that's clearly the route that they've chosen. And I think on the very early stages, that looks quite promising, I think. But again, this is all reflected in the rating. So you're only paying 8 or 9. 8, I think 9 now for Astra shares for this year. So it's at a big discount.
GSK shares.
Sorry, yes, GSK shares. It's at a big discount, but that also reflects the fact that it's coming from a standing start.
Indeed, a lot of moving parts there, as there always are with Pharma, and now there's the uncertainty that they, like pretty much everyone else, faces in the US, as you touch on there. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. Now we're going to turn to more domestic matters in the shape of Crest Nicholson. Natasha, these results were delayed for a few weeks. They are now finally out. There was some issue, as there has been for a while at Crest and peers, over fire safety costs. But what did we learn from the figures themselves about Crest's current situation and those costs and the outlook?
As you said, they were delayed for a couple of weeks because they were still auditing the fire safety figures. They eventually increased the fire safety provision to 249 million, which is a pretty big increase compared to the figure that they gave at the half-year point. So on the surface of it, obviously it looks big, but in the long run, the big increase in provision can actually be a good thing because it gives greater certainty about how much fire remediation will actually cost Crest. And they've also now conducted a survey of, I think it's 211 homes' external walls, and they've estimated the expected cost for the remaining 80 homes. And all those surveys should be completed by June 2025. So it does give investors more comfort that those are close to or at the final cost for Crest, because the uncertainty had been weighing on their share price for some time.
You hope this will be
Fingers
drawing
crossed.
a line under it, but we have been in this situation, haven't we, for a few years
Yes.
now. I mean, this is a very serious issue, of course, but at the same time, they've taken a very incremental, as have most companies in the sector, a very incremental approach. It's probably a polite way of putting it.
Yes.
Underestimating for a few years is probably just as accurate.
And the way that different companies have been recognising those costs at different points. So some will have looked at all the buildings and estimated for all of those. Some will be giving out estimates as and when they look at each building. So it means the investors just need to be very careful about working out how high they think the final cost might be.
We'll come back to the outlook in a second, but I just want to address the going concern point, which obviously made headlines this week. Is it a big concern? I mean, clearly it's not a good situation if you have to put that disclaimer in there, but at the same time, it does feel like things would have to get quite a bit worse, seriously worse for the housing market for that to become a real issue.
Yes, and that certainly seemed to be the consensus on the day. So in the morning, there looked like there was quite a lot of concern when I think investors read that section of the report, and we saw that the share price initially dropped by 5% before rebounding and then dropping again, which suggests investors were having quite a quick reaction to what they'd read. However, as one of the analysts at Investec, Ainsley Lavin, pointed out, it seems to relate to a severe but plausible downside case. So yes, it could happen, but it's not sort of at the top of the list of things that might happen in the future. So, I mean, in short, yes, it's something to watch out for, but there are also lots of other moving parts with Crest to look out for as well.
Looking at the year ahead, one thing I noted, they pointed to planning delays as a reason for a reduction in sales outlets for the year ahead, which again speaks to a wider conversation. Clearly, the national conversation about planning that we are having, or the government's trying to have and trying to change, it just goes to show perhaps that will take time, and that just because these issues are starting to reach national prominence doesn't mean that companies aren't going to face issues with the system in the year ahead, if we believe Crest's using that as a reason for lower sales outlets.
Yeah, the planning point's been quite interesting because the new government's been talking about planning pretty much since they got into power, and they've portrayed it very much as a solution to the problem. But the current house builders results for this year demonstrated that there are other things in play. So completions are down at a lot of the house builders. And this is partly because of the demand side. Because mortgage rates have gone up a lot, it then means affordability is stretched. House builders build to what they can sell. So if buyers aren't coming forward with those mortgages approved and can't make the purchase work, then they won't build that home. So it's one part of the puzzle, but there will be more focus, I think, going forwards on the other parts of the housing market that are holding back delivery.
Crest has a capital markets day next month. What kind of things could we maybe expect from that?
Yeah, so the new CEO, Martin Clark, took over last summer. So this will be a good opportunity for the market to get to know him a bit better and get to know his plans for the company. Crest has been in, a bit of a sort of, downturn for a few years. It's had a string of profit warnings, and then it also had the aborted merger with Bellway, which collapsed last year. So I think investors will be particularly keen to hear what he wants to do with the company and where he intends to take it. And they'll be looking for more confidence from him. Yeah,
I'm going to bring in Alex at this point. Alex, what are your thoughts on Crest? Clearly quite a troubled company, even in the context of a sector which is still far from the peak of the cycle. What's your view?
Yeah, I mean, it's a bit of a Rorschach test of a company because it seems like it could go one of two ways. I know that's the case for every share that we talk about, but it feels more precarious now either way because of some of the underlying moving parts. So just to return, just to add a bit more colour to the covenant point and the debt issue. So it has 3 financial covenants on its senior notes and revolving credit facility. So 2 of them, I think its gearing and its tangible net worth are absolutely fine. The issue is with this adjusted operating profit interest cover, which is currently I think 3.5, and for it to pass the covenant, and the next test is in about a month and a half's time. It needs to be 3. So at the moment it's okay, but it's not in the in the happiest place as Natasha just outlined. So obviously good news today that the Bank of England is cutting rates because that reduces its ongoing interest costs. But the whole question is, can the EBIT part of that ratio, and I think if they do test the covenants, it's not going to be a big deal because they can always amend them. But it really kind of gets to the heart of where what direction the business is going to go in this year, because the real test is, can this EBIT, adjusted EBIT figure inch up? So I think their current, their adjusted operating margin was something like 5% in 2024, which is tortuously low for a house builder in the current environment. And a capital markets day, there's a lot riding on it, but I don't think it's going to change anything overnight. So he's, maybe we can discuss a little bit what Martin Clark's planning for it. But I think the more immediate concern is that we might get a return of the M&A story. So Bellway walked away, as we said, from the proposed merger that last year, but they did say that it made a lot of sense. And we have seen a lot of consolidation in this sector because it's been in a trough really for the last 3 years. So if not Bellway, there may be another suitor out there that thinks that Crest has actually got a couple more years before it's really going to right itself, and now actually represents a decent point when there's a lot of nerves around the shares for various reasons to get them at a relatively cheap point on a 5-year view. So yeah, I think the M&A story's not gone away, and I think the capital markets day is going to be quite a hard sell. But maybe you can pull a rabbit out of the hat.
Indeed. I just looked, and I think next week will be 6 months since Bellway walked away, so might be a date to watch out for, given pauses that must be taken on these things run to about that length of time, and after that maybe they'll be free to return. I wanted to talk about one demand side incentive program, should we call it, which could help the shares, the sector, which is Help to Buy. The previous government clearly was quite keen on this, but there have been a couple of noises in recent weeks. I think RBC flagged up that the government has hired a consultant to look at the effectiveness of the old Help to Buy scheme, which seems to suggest it may be considering bringing it back. I mean, that clearly, Natasha, would be very good news for Crest Nicholson, one would assume.
Yes, so it would be good for the whole industry because Help to Buy was pretty popular with the house building industry because it gave them greater certainty over buyers coming forward to purchase their properties because buyers had equity loans from the government. But it's one thing to say that they're appointing a consultant, but quite another to actually bring the policy back. So while the industry has been lobbying overtly or covertly for the reintroduction of Help to Buy for some time, it's unclear whether the government will still bring it back, depending on what the consultant says. And one of the other things to watch out for is the headlines associated with the policy. So there's some debate over whether or not Help to Buy actually pushed up house prices. But a lot of the headlines at the time focused on increased house prices and also the increased profits going to CEOs and shareholders. So a quick scan back through profits, through articles about Persimmon in particular, highlighted a kind of attitude that Help to Buy was basically handing house builders mega profits and making shareholders rich while pushing up prices of homes. So whether or not that's actually true, we'll find out from the report. But certainly the perception of it would be tricky for the government to handle, particularly as affordability is such a big problem.
Yeah, it remains to be seen whether they go down that path again. Let's just wrap up on Crest with the valuation, because as you might expect, given all the things we've discussed, it is fairly cheap at the moment. Alex, you've already said it's a bit of a binary call in your view. Natasha, what's your view on the valuation at the moment?
Yeah, and I think I agree with Alex that it's a pretty tough one to call. I mean, in terms of valuation, it's trading about 17 times forward earnings. So it's fairly healthy and does imply that the market's factoring in some improvement in earnings. It's also trading at below book value, which people often use to show that a house builder is looking cheap. But I mean, for context, Bellway's trading at 14 times forward earnings, Taylor Wimpey's at 13 times, and Persimmon's also at 13 times. So it's not that cheap compared to other house builders. And those other house builders have greater certainty over their model. You know, they haven't had the same sort of string of profit warnings that we've had with Crest Nicholson. So, I mean, all in all, yes, it could be cheap, but it's quite a brave call at the moment to make.
Yeah, that's certainly a fair point about those forward earnings. It's not quite as cheap. And we'll wait to see, I suppose. As I say, there is the Capital Markets Day coming up in just a few weeks. There is the potential, albeit much more loose as we've established, for some bid activity and Help to Buy bubbling in the background. So a lot of things going on there. It's time for our final segment now, looking at the FTSE 100 catering group Compass, which has had a very good time of it operationally, share price wise, over the past couple of years. A short trading update out today, Mark, but some good figures in there again.
Yeah, there wasn't a great deal of detail in there, moving on from November when they reported their full-year figures. But we're looking at an organic growth rate for revenue of 9.2%. That's pretty much in line with guidance at the full-year mark, which was for high single-digit growth. We've also seen some progress on margin progression as well. Profit growth was a little bit slower than expected, but that's on a reported basis, and that's hardly surprising given the company is still pursuing a fairly ambitious M&A program too. So yeah, that was quite pleasing in terms of shareholders there. It's a combination really of there's been quite a few new business wins, which is always pleasing. Then there's the effect of the M&A as well. The picked up a couple of new subsidiaries in the first quarter, DuPont, which is a restaurant service group in France, and a Norwegian firm, For Service. But one point that's worth making as well is that we've seen very little slippage on the revenue front as well because of the group's high customer retention rate, which is quite notable really compared to some peers in the sector too.
Yeah, one thing I'm just going to remark on the organic growth rate is that this growth is its first quarter growth, so a relatively short period of time, but pretty much double what comparable peers. There's Aramark in the US and Sodexo, I think that's how you pronounce it, in France, produced. Compass is more like 9% versus 4.5%, 5%. So it's definitely outstripping the competition at the moment.
It's not only outstripping on that basis, but in terms of the margins as well. We can get onto that shortly. But certainly, another factor worth taking into consideration as well is that Compass has been moving out of some of their more marginal contracts and some locales as well, which is also supporting profitability. Even though on a reported basis, they've had sort of really heavy capex commitments, and if anything, the Q1 update suggests that might increase through 2025 as well. So they're building market share, but they're still on underlying basis. Those margins are looking pretty good. When I looked at it earlier on in the consensus figures, and I had to sort of strip them out a bit because there was one or two companies in there that I don't think we're comparing like with like. But when you look on a cash, a trading, and a net basis in terms of the margin as well, it's outstripping all of its competition on that base and quite significantly too. So, looking at the rating for the stock as well, it's not surprising that on a PE basis, it's also outstripping its rivals. So, I mean, you're sort of paying for quality there. Mm-hmm. Plus, it's got the beta is 0.76, which suggests that it's not as volatile as those competitors in the market too. I did have a look at the growth rate, the PEG ratio too, which isn't necessarily totally applicable for a company like Compass because the growth tends to be incremental even with the M&A too. But it suggests that the market is pricing in decent expectations, and a lot of that will come down to M&A as well.
Mm. Yeah, it does seem a lot of people right now expect structurally higher growth for Compass in future, even once we've come out of, which we arguably have now, of this post-pandemic rebound in catering. Things like outsourcing, increased outsourcing, market share gains are clearly crucial in this sector because that's how you make most of the new money. It also seems to have done very well in Europe, applying perhaps the lessons from its North America business to Europe and focusing down the locales, as you say, but really concentrating on the core markets and doing much better there if you look at the growth there. Maybe I'll just bring in Alex again for your views on Compass, because it has had a very good time of it. It does seem to be doing a lot of things right operationally. It is relatively richly priced, but perhaps with good reason, as Mark said, a quality share perhaps. What's your take?
Yeah, I mean, if you think the reasons why investors like this company, and they clearly like it if it's priced at 26 times forward earnings, though, yeah, I mean, that's in line with the 5-year average, pretty much, as expensive as that seems. It's that they just keep doing year after year what they've been doing. So, they're growing volumes and prices, retaining and growing the existing clients, and they just consolidate through acquisition. So their aim to be a sort of earnings compounder, I think, is justified and likely to continue because outside of a massive pandemic shutdown, it's proven a really defensive stock and has grown very strongly throughout a choppy period for the global economy. So it's clear that in their sector as well, the economies of scale here really work quite well. So there's a lot of I suppose, growth that they can take off both the regional players and the self-operated caterers and outsourcers, as well as it being a market that's growing at 5% a year, according to a few measures I've seen. So yeah, and the other thing, I just looking at their the results of the last couple of years, I think interestingly it's probably been one of the best plays on the home working trend in a way. So while real estate has kind of floundered and we've not been able to get a handle on what the use case is for a lot of real estate in the years ahead, particularly with offices, I suppose one of the big ways employers have been able to differentiate themselves or entice workers back has been to offer some sort of workplace catering. So, they've really tapped into this drive within companies, not only to outsource something that's non-core for them, but as a kind of a perk for their employees. So that might change in the next couple of years, but the foundations of the market don't seem to be changing too much, which is really good for them. And, it's hard to see a real shock to this sort of earnings growth in the next few years. As I said, absent another pandemic or inability to function globally, which our base case has to be it's not going to happen.
Yeah, we hope that's not going to happen. Yes, I think it's fair to say it has been one of those winners, hasn't it? And you do get Compass saying whenever there's articles, as there have been recently, about not just articles, there have been companies inviting quote-unquote workers back to the office on a more permanent basis. Compass is always there supporting that because they tend to get a lot of good business from it. I saw some figures from Jefferies, quite interesting, on the proportion of business and industry catering that is still self-operated versus outsourced. I mean, as you might expect, outsourcing is much higher there than it is in some of Compass's other segments, such as education and healthcare, where in a lot of those cases is self-operated. So maybe there's some more growth in those markets for Compass as well. But for now, all seems set relatively fair. On which positive note for Compass shareholders, we will wrap up the show because we have come to the end of our time. So thank you very much to Alex, to Mark, to Natasha, to Julian, and to our producer, Maddie Apthorpe. We'll see you next time on another Companies and Markets show.